Hello. Happy March 9th to everyone joining me today. Welcome to the Equifax Canada Commercial Credit Trends webinar. I'm Sinead Gleason, Commercial Solutions Product Lead here at Equifax Canada, and I'll be walking you through today's look back at the fourth quarter. Here in Toronto, spring feels like it's right around the corner, although the winter is definitely not finished with us yet. But I hope the sun is shining wherever you are joining us from today. So before we dive in, I will pass things over to my colleague Sandra, who's going to walk us through a few housekeeping items. Sandra?
Thanks very much, Sinead, and good afternoon, everyone. Each area within the On24 webinar platform is responsive, so you can maximize or minimize each widget or box on your screen based on your viewing needs. There's an Ask a Question widget underneath the slide area, so feel free to enter any questions you may have, and we'll address them throughout our session today. In the event there's too many questions to get through, we'll generate an FAQ document, which we'll send out to you in the coming weeks. Some related content is available for download in the related content area. Our presentation today in English and French will be available in the coming days, and our session is being recorded, so you'll receive the on-demand link via email also in the coming days. Some additional features you'll notice at the bottom of your screen are reactions, let us know how we're doing, our survey, which will pop up at the end of the webinar, and contact us. Feel free to check any of these out and provide your feedback. Now let's get started. Sinead, back to you.
Thank you, Sandra. So before we dive into the Q4 trends, I would actually like to take a moment and introduce the newest member of the Equifax family. On February 1st, Equifax Canada announced the acquisition of the Food Industry Credit Bureau, the leading provider of credit information for the food industry in Canada, from Profile Credit. The acquisition expanded the breadth of commercial credit insights available to Equifax customers. And joining me today to talk a bit about all of that is Jean Gauthier, founder of Profile Credit. Hi, Jean. Welcome to the team.
Well, thank you very much, Sinead. We're very proud of it, actually.
Yes, it was quite a long haul, quite an accomplishment, a lot of work going on behind the scenes. So what can you tell us and tell our audience about Profile Credit and what it brings to Equifax?
Well, Profile Credit, we're known as well as the Food Industry Credit Bureau. So we've been in business for over 31 years. We were specialized in the food, agro-food industry. So that means that we covered the entire food industry, which means the food service, the restaurant, hotel, institution, raw ingredients like the cereal, grain, salt, sugar industry, manufacturers like the Heinz, Nestle's of this world, Coca-Cola, the agricultural industry. So we're very, very strong in the agricultural industry in Quebec, the Quebec market. So we covered the entire industry, including the pork industry, like dairy farms and so on and so on. The meat and poultry industry were very strong as well in that industry. So we this is what we are. So we know the food industry inside out. So we have a small team, but we had a lot of data, $5 billion worth of data per month, actually, that we were ingesting into our database. So, yeah.
Yeah, and one thing that I think you're very strong with, which was one of the reasons that we were very much interested in Profile Credit, is the strength of your credit industry groups as well. And I know, Jean, that you attend many of those credit meetings. You're front and center for a lot of direct insights in terms of what's happening in real time within the food industry. Would you be able to share your perspective on the state of the food industry right now?
Well, it's obviously like a very I would say could be a tough time, I would say, for some of the members, not the members, but the businesses in the food industry. But there are some winners as well. So the brokers, the distributors and the food chain are gaining actually from the food inflation, for example. And the restaurant industry or the small manufacturers that don't have necessarily an accountant, that are more artisanal,
Artisanal, yeah.
artisanal. So they're really small, and they have some difficulties actually with the fluctuation in the prices. The interest rates obviously are affecting lots of these businesses. We've been noticing some slowdown in the payments over the last year. Since the interest rate are increasing, are going up. The fact that the government loans for the COVID actually have to be reimbursed, that puts a lot of pressure on the small businesses as well. The fact that people are working from home, this has a lot of impact on the restaurants actually in the downtown location, especially in the big cities. And the slowdown in the economy as well that we're noticing right now, where people are hiding their wallet right now, and they're not going to the restaurants as much as they were. The restaurant industry is being affected. The small, the chain accounts are not being affected as much as the small restaurants, like the pop and mom and pop type of restaurants. But the restaurant industry is being affected in general. Yeah.
Definitely. You talked about all of the data that Profile Credit was able to bring into the Equifax environment. And, that information is so full of good insights into the food industry. I know that we made some significant investments on the platform as well, having brought everything over into the Equifax environment. Can you tell us a little bit about the new platform and the database, generally speaking?
Yeah, the platform looks great. I've been showing the platform to maybe 600 of our members so far, and they really like it. So it's very easy to use. The credit reports looks great as well. They're, obviously very similar to the one that we had at Profile Credit, and the data that we combine, that we brought over, and that we combine now with Equifax, makes it even better for everybody. So it's great.
That's great. That's great to hear. Okay, if there's anything else, I'm not sure if you want to share with our audience before we start jumping into the credit trends.
Well, I think it's a great marriage between a small company and a big company, and we have the vision to bring that over in other industries, and to bring that over in other countries as well. So the potential is there. We bring a lot of granularity into the reports and into everything, because we are very specialized in the industry. So this is something that we're really good at, and hopefully we're going to bring some of that into Equifax.
Yes, we're very happy to have you. It's been wonderful.
All right. Thank you very much.
Thank you very much, Jean. All right. So with that, why don't we jump into the industry update? So we can go back one. 2022 was quite an eventful year for Canadian businesses. So we're sitting here in 2013 in real time. But, if you think back to last year, we saw trucker protests in Ottawa, and in the war in Ukraine began. Omicron variants hit the scene, and Canadians experienced shortages on cold and flu medications. Supply chain issues caused shortages on so many goods and services, and that had a real ripple effect throughout the entire economy. If you think about used vehicles, for example, they were in really high demand because there were just the constraints in terms of getting new vehicles to market was so strong and pronounced. We saw massive price increases at the pumps and in grocery stores just prior to going live. We were talking about the price of butter, for example. In fact, use of food banks actually hit an all-time high in Canada during 2022. So Canada's economy began to really heat up, and concerns about inflation caused the Bank of Canada to continuously raise interest rates. Our dollar hit an all-time low in 2022. Many experts were warning of like a looming recession. Canadian businesses were experiencing labor shortages to a really large degree and also paying record high labor costs. But businesses actually did start to rebound from the pandemic, albeit cautiously, and we'll take a little bit of a look at that in a minute. And so as we sit here comfortably in the first quarter of 2023, let's dive right into it and take a look back at the fourth quarter and see how things played out. Okay, so continuing a trend that we saw all throughout 2022, the job vacancy rate continues to climb into the fourth quarter. So that really is growing the gap between the unemployment and the employment levels. And in terms of labor costs, those have really continued to increase. And the Bank of Canada, however, just yesterday did halt any further rate hikes for the first time in over a year, as signs of inflation are starting to ease a bit. So that's good news for both consumers and businesses for sure. If we flip over to the next slide. So what we're looking at here is the Bank of Canada rate hike in the yellow line. And as you know, we all experienced, it just kept on climbing throughout 2022. And in gray, we see the consumer price index as it started to really hit strong in the first quarter there. And then as the interest rates started really going up, that started to settle down a bit into the second half. GDP growth slowed, noted by that red line there, trending downwards in Q4. So it looks like inflationary pressures are easing. We do see businesses borrowing less, suggesting that the rate hikes are satisfying the purposes of cooling the economy. But that labor market continues to tighten. So we'll have to keep an eye on that trend throughout 2023. And Statistics Canada had noted that non-financial corporations have accumulated large cash deposits, which could help fuel investments. They've also noted that 6.3% of Canadian businesses plan to expand in the next 12 months, with manufacturing firms noting the largest intent to expand. And so in line with the employment vacancies, businesses are also concerned about being able to hire talent in the next 3 months. Okay, so let's take a look now at the Q4 Equifax commercial risk data. So in Q4 of this year, small business debt levels grew to 38.4 thousand on average, which was an increase of 2% versus the third quarter and nearly 10% versus the same period last year. Insolvencies grew within Canada at 26%, but close to 40% when we compare to that same period last year. So that's definitely a significant increase. The 60-plus delinquency rate sits at 5% this quarter, which is up both year over year and quarter over quarter as well. And looking at new business openings, which we'll get into in a little bit more detail in a few slides, that number is up quite a bit this quarter compared to the same period last year, as well as up versus last quarter. So a promising trend actually as we head into 2023. Okay, so let's now take a look at credit demand. And on your left-hand side of the screen, we're looking at inquiries, which is an indication of credit-seeking behavior. And you see that very pronounced drop in the high-risk score bands, or that gray line there in Q4, which is 4% lower than Q4 of last year. Overall, though, Canadian businesses did seek more credit in the fourth quarter than of last year, to the tune of around 2.5%. And like we saw last quarter, it's those businesses that are aged 7 to 24 months and the older, more established businesses that are fueling that growth in demand. Okay, so on the credit supply side, we're looking at banking trades specifically in this chart, and we start to see an interesting difference actually between what we'll see on the next slide, which is the supplier trades. But for now, what we're looking at here are the number of new trade lines or credit products that were opened by businesses within financial institutions. So echoing what we saw in the previous slide, those businesses aged 7 to 24 months and 60 plus are the drivers of the new trade growth, as indicated by the yellow and the green trend lines. But on the right-hand side of your screen, you'll notice that the distribution of those trades continue to grow within the lower risk segments. So really signaling that banks have been increasingly cautious with lending, taking a more cautious approach to risk. And so let's now look at the same scenario within the industrial or the supplier trades. And here, you'll note quite a contrast to what we saw with the financial trades. So the new trade activity was more evenly paced in 2022. We don't see those spikes that were observed in 2021 amongst the more well-established businesses. The distribution is also fairly even across the age groups of businesses this past year. And on the risk side, suppliers are seemingly more in a kind of get back to business kind of mode. The distribution of new trades is evenly split between the higher and lower risk bands. In fact, the higher risk score bands are growing quite visibly in contrast to what we saw on the banking side. So suppliers do seem to be willing to take on a bit more risk in order to get back to business. Definitely an interesting contrast between those two dynamics. And then if we look at the regional credit supply, so where those new trades are coming from, really it's Toronto that seems to be where the new activity has heated up in this quarter for both banking and supplier trades. So now let's look at new business openings. So an interesting trend played out this past year in 2022. So typically what we see in seasonality in the second and third quarter, you see that spike right in the second and third quarter when it comes to business openings. And then things typically level off and slow down in Q4. But in 2022, we see that economic environment that everyone was operating in really had a bit of a leveling effect on new business openings. That really strong Q4 growth that we saw off the top of the presentation, that's in comparison to the same period last year. However, overall, quarter over quarter, things were way more even keel. 2022 really was a year of business owners taking a more cautious approach due to all the challenges that they were facing, like supply chain constraints and rising interest rates, and rising rents and staffing challenges, everything. So it really is quite remarkable to see, like just visually here, how much that seasonality flattened this past year. And then notably, on a quarter over quarter basis, the growth that we were seeing is driven by Ontario and Quebec. Okay, so we're going to take a look now at roll rates. So what we wanted to do was to have a look at how accounts were aging in terms of going from current to 30 days delinquent, from 30 to 60, and then from 60 to 90. So that red line there, you're seeing that's going from current to 30. And here on this slide, we're comparing that between the financial trades on the left and the supplier trades are on your right. On the financial trade side, you notice that really huge dip in May of 2022, it's possibly due to some of the federal relief payments being used to pay down existing debts, because the roll rates dropped quite significantly there. And as time progressed to Q4 2022, that remained fairly low. This is also coinciding with that, that cautious approach that we saw in the earlier slide, where those new financial accounts are being opened more and more amongst businesses with the lower risk score bands. In comparison, on the right-hand side, we see the supplier trades did experience a bit of a slight drop in roll rates during May 2020 timeframe, but not quite as drastic at all. And as we move into 2022, they really start to get back to where they were prior to the lockdown. So again, illustrating that suppliers are lending to higher risk segments, and the roll rates are beginning to reflect that once again. Okay, so now we're looking at the delinquency rates themselves. Here we're comparing the financial trades and the supplier trades. So you can really see that the delinquency rates in the fourth quarter of 2022 increasing for both. However, financial trades, when compared to Q4 of last year, they're down for the most part. So that strategy of taking a more cautious approach when it comes to risk is having an impact there. And on the supplier side, as businesses opened up this year, those delinquency rates are starting to trend back upwards. So it will be interesting to see how this all plays out in 2023. If those rates will get back to where they were prior to the lockdowns, we will wait and see. So if we look at each industry, retail trade had the highest growth of 60 days plus delinquencies at 6.1% versus Q3. And at a year-over-year basis, almost all sectors are reporting strong growth of 60 plus delinquencies, with the exception of construction, which is effectively the same as last year. Okay, and then finally, looking at the bankruptcy rates in Q4, we looked at the Credit Institute of Canada's data map, which does a really nice job of illustrating the change in insolvencies for each province monthly. And you can see that in Quebec and Ontario, that they reported a significant increase in the last quarter of the year. However, these are similar levels to what we have seen historically. So it could be that we're starting to return to a normalized level of bankruptcy rate. Okay, and with that, let's recap the highlights of this quarter's business credit trends. So really, I would say that the theme was really around cautious optimism, I think. So while we did see bankruptcy rates grow at a really alarming percentage this quarter, that was tempered by a stronger than typical Q4 growth of new businesses. And so yes, while 2022 was much more conservative in terms of business openings, generally speaking, and those seasonal spikes were definitely flattened, there is optimism within businesses for opportunities as we head into 2023. So delinquency rates were beginning to trend back upwards this quarter, particularly within the supplier trades, where we saw the third consecutive quarter of early delinquency growth. And when we looked at the banking trades, we saw a contrast with the roll rates, as lenders appear to have proceeded with a greater degree of sensitivity to risk throughout 2022, which may result in better performance in the coming quarters. And on that theme, the share of high-risk borrowers inquiring and opening new trade lines is falling amongst financial trades, as opposed to supplier trades, which reported a higher risk segments on the rise. And that really brings us to the panel discussion of our session today. And so joining me for the deeper dive into everything that we've just looked at is my esteemed colleague, Josh Farrington. Josh is a commercial consultant who focuses on the financial institutions here at Equifax. He works with the banks. Josh is joining us from BC, so welcome, Josh.
Thanks for having me.
Thank you.
Good to be here.
Thank you for joining me. What I think we'll do before we dive right into our chat is maybe we'll pause for a little polling question. We'll get the audience's pulse check and see what we can flip. So, audience, if you're still with us, so to what extent do you agree with this statement? We're experiencing a market downturn in the industries that we support. So if you can take a couple of seconds and give us your thoughts. Do you strongly agree? Are you unsure? Or do you strongly disagree with that statement? We'll see how those results come in. Get to have a look and see the results. Yeah, agree. I guess it makes sense. Agree and unsure, actually, which I find really interesting. And so, Josh, how do the trends that we've just kind of dived into there, how does that line up with what you're hearing from your customers that you're dealing with?
Yeah, it lines up pretty well. There's been a lot of talk or a lot of concern around the insolvency numbers. Yeah, they are elevated. We've done a little bit of deeper digging on sort of what comprises those insolvencies, and it seems like there's a lot more of an effect on small business in particular, which of course are more heavily impacted by the market conditions right now. And then as represented by those roll rates that we saw, I think there was some concern about the federal loans, CEBA and HASCAP, And how that money was being allocated, I think it's pretty clear that some of it, even though it wasn't really supposed to be, it was used to, repay loans, pay down on loans, and ensure that that they weren't moving into days past due, those further day past due buckets. And then I would say that there is a bit of optimism happening right now, where a lot of lenders are looking at ways of capitalizing on market conditions. And even though through the pandemic they really tightened up the belt, I get the sense now that there's a lot of lenders looking to be a little bit more opportunistic and find industries of focus, with, of course, manufacturing being a key one, and then also the agriculture sectors, which plays nicely into the acquisition of profile credit.
Yeah, definitely. Okay, let's take a second polling question. Let's see. Okay, to what extent do you agree with this statement? The economic downturn is impacting our clients' businesses. So I know we have a breadth of folks in the audience from across different industries, different sectors, banking, government, industry. So I'm curious to see how perspectives are, because your customers are from all over the place, but how is it impacting customers' businesses? Is the current state of affairs having a marked impact? And let's see, do we have enough results in to go? Agree, yeah. Okay, so given the economic slowdown, Josh, that we are experiencing, what are your perspectives on how priorities potentially are shifting at the banks, if at all?
Yeah, no, I think they're shifting quite a lot. Seen a pretty big focus on automation, from the perspective of improving margins for sure, but also catching up. Historically, retail lending has been a little bit more technologically advanced, just due to volume than business lending. But we're seeing a lot of focus now with that downturn and that sort of limiting of credit to improving processes, back-end processes, streamlining, and also making application processes more web-friendly. I think that again, it was business lending has often been done a little bit more face-to-face at the branch level, and now we're looking at creating more of an online experience for business lending akin to what you'd see on the personal side. And then, as I mentioned, there is now starting to be, now that the economy is sort of settling, we're seeing, inflation balancing out, interest rates calming. We're seeing a real focus on opportunities. Where can my business start to expand? Where can we start? What industries can we start focusing on? So that's a pretty good news story. And then, of course, client retention is always important, especially as we go through these times of change within the whole business environment. And then probably one of the biggest focuses is also on portfolio management. Lots of discussions around regulation and increased oversight. I think now more than ever, it's important to have a really good line of sight on that existing portfolio, to be able to spot those problem accounts a little bit earlier. And then, of course, have a real good line of sight on what areas are performing well.
And are you able to share with us a little bit about how you're working with your clients as these are some of their priorities? Like, how are they working through those types of issues?
Yeah, you bet. So, in terms of automation, a lot of them are looking at leveraging multiple data sources. And we do have a great tool now for that, to combine data sets. And then also I mean, the acquisition of Profile Credit is a great example of that. We've got these new data sets that haven't been available to us in the past. Also, we have Ansonia now under our umbrella that that has shipment data going in and out of different companies, as well as PayNet that's been around for a little while. But we have all of these different data sets that we now are looking to combine and really put together some really powerful decision tools to help with automation, to help with streamlining process flows.
Awesome.
So that's one. And then, there's also just in general, again, going back to automation, to opportunistic growth, really finding those areas of opportunity. The lovely thing about commercial data is that we're not governed by legislation, and we can share a lot more information about specific businesses to find which ones are performing well, and to provide those in terms of a lead.
That's awesome. Okay, well, thank you for sharing that. That's very much appreciated. It's nice to kind of get the kind of like the inside perspective. So I appreciate that very much.
My pleasure.
So why don't we go to our third and final polling question? Let's answer the question. To what extent do you agree with this statement? Our business is confident that there are opportunities for growth in the current economy. I think with the Bank of Canada's interest rate announcement yesterday hopefully helped on this one. And just a reminder too, oh, there we go. So yes, they strongly agree that business is confident there's opportunity for growth in the current environment. But you know what, still a little bit of like, not so sure. So that makes perfect sense to me. Just a reminder that actually if you want, you can submit questions in the On24 platform there if you want to do that. And so, Josh, any parting final thoughts that you want to leave us with today?
Yeah, I think that it's easy to get into a little bit of a doom and gloom scenario when wherever we're doing these economic updates or business trends, but I think that there are actually some pretty good news stories in here with the rebound of those supplier trades. It's a really great early sign that we're starting to see stuff come out of a slowdown. I don't know if we quite got to recession, but anyway, a slowdown. So yeah, I think there's a lot of positive coming out of this.
Yeah, I would totally agree with you. It's it felt like a nice kind of upward swing into 2023. So hopefully we'll see that carry on. Okay, thank you very much, Josh. I appreciate you joining me today. We'll just flip over and see, do we have any questions? Yes. We have a question about the roll rates that we shared. Can we go back to that slide and clarify if those are past dues? So they are the movement of the accounts that roll from current to 30. There was like three buckets. The percent that moved from the 30 to 60, I don't know. And the the 30 to 60 and the 60 to 90. So it's a bit of a...
I believe that's slide 14.
Slide 14, a bit of a brain twist on that one. Yes, so that is how that is defined. Hopefully that's, there we go. And see if there's any other questions. Nope. Yeah, we do. Pause as we copy and paste so that I can read. Yes, the slides definitely will be shared. We will be mailing or emailing out both English and French when the French is translated, and we will make sure that everyone who's joined us here today will have access to all of these things. And is that it? There's one more coming. I feel like playing the Jeopardy soundtrack. Credit insurance trends in Canada. Do companies leverage that as a risk tool? Credit insurance trends. That is a very interesting question. Josh, I don't know if you have any insights at all in terms of credit insurance trends in Canada.
It's definitely leveraged a lot. And actually, Insonia has some of that featured within its data set. Credit insurance and factoring is definitely being used. In fact, it's provided by the government for Export Development Canada provides that. In terms of an increase in the usage of it, I'd be hard pressed to say, but it's definitely something we should look at for future credit trends.
Okay, we'll definitely keep that in mind. And how is the construction industry performing? Are they accessing new credits? So I don't know if we still have Jean. I think Jean, you're still with us as well. I don't know if you have any thoughts, or Josh, do you have any thoughts on how the construction industry is performing?
The construction industry is always a pretty big challenge. Supply is still really difficult for them. We've seen it represented in a number of different ways. When we look at, I think it was actually in this presentation, it has, in terms of that 60-day delinquency, I think it's on slide 16, within the construction industry, that actually has gone down year over year, which is a good thing. But quarter over quarter, it has gone up a bit. It's usually one of our higher risk industry segments. So has there been a big change recently? Not substantial.
Right.
But yeah.
Yep. I don't know. Jean, is Jean with us still? Yep. Do you have any thoughts, or mostly no, because focused purely on food industry?
Yeah, mostly food. I could probably answer the question on the
Insurance?
The credit insurance. Yeah, it's definitely a nice tool to have in order to grow. I'll give you an example. There was a meat industry distributor in Quebec that wanted to grow across Canada. So they realized that by paying like having like a credit insurance policy was very interesting. Even it cost them like over like $100,000 because they went into a market that they didn't know, and they expanded their company, and they made over like $300,000 in profit, with that growth. So after a couple of years, they let down the credit insurance because they knew enough about the market. But in order to grow, when you don't know where you're going exactly, in which industry, if you're growing too fast, it could be a really nice tool to have.
Yeah. Okay, we have an interesting question here. What is your crystal ball? What do you see as the future in increasing rates and lowering disposable incomes? Anyone want to tackle that one? Does anybody want to get the crystal balls out?
Disposable income is a tough one because we're also seeing wages increase. So, which arguably is helping buoy inflation. But in terms of increasing rates, it's definitely going to, we've seen those trends reflected where, those newer businesses are potentially a little bit more challenged now than they have been in the past. With sort of mid-tier businesses that have been around a little while, 17 to 24 months, I think it was, being able to weather the storm in terms of increased rates. I honestly don't think, I think it's probably going to be a positive story that with sort of the macroeconomics the way they are, Canada is pretty well positioned to capitalize, especially in manufacturing and agriculture. So yeah, it's crystal ball is probably things are going to get better for us, even in spite of increasing rates and lower disposable income.
Right. Okay. Here's one for Jean. So with Profile Credit now on board here at Equifax, are we considering a raw materials credit group?
We have one actually. So with the Quadra and red patch sugars of this world, and we have some chemicals companies as well that are part of the this group. So yeah, just feel free to contact me actually, and we'll bring you on board actually for the next meeting. Yeah.
That sounds great. Yep. Open invitation there.
Yep.
That's wonderful. Thank you. Any other? Yes, they're still coming. This is awesome. Okay. How do we see delinquency trends moving over the next 6 months, especially in small, medium business? So I don't know who wants to tackle that one, because we definitely do see the delinquency rates have been on the rise. Well, we did notice that market difference really between the FI space and the supplier trades. Who would like to tackle that?
Well, we had a speaker at once. We organized a lot of conferences at Profile Credit, and we had a speaker from can't remember. That was a trustee, and he was talking about insolvency, especially, are happening sometimes like 6 months after the interest rate, after the impact. So right now we're going through lots of impacts in the economy, you know, like with the food inflation, the war, all these things that are happening right now that I mentioned earlier. So we might see the ripple effect, like maybe in 6 months to a year from now in some industries, depending on which industry you're in, actually.
Yeah.
I'd agree with that as well. You're also keep in mind that we're still below pre-pandemic levels quite considerably with 6 months delinquencies. So there's bound to be normalization. There should be normalization. That's a healthy thing to see. To Jean's point, the larger concern is the lagging insolvencies. You know, come this April, May, June, what's going to be happening in terms of those businesses that are now really having to cope with those rate hikes.
Yeah. Yeah.
And I always use actually with my members the term, you know, you have to go back to basic, B2B for business to business, and back to basics in difficult times, and to find out, you know, and how to assess credit with your customers with the 5 C's of credit, you know, cash, capital, collateral, the character of the small business owner is very, very important, actually. How do they react, you know, when you talk to them about the economy, when you talk about the challenges that they're going through right now? The character is very, very important, actually. And the condition of the market. So are they located downtown Montreal, you know, where people are working from home like 3 days out of 5 now? That's the kind of thing, you know, that you have to look at.
Yeah. There is another question here for you, Jean. What different dynamics do you see in the food industry given the payment terms that are present with perishable goods? So typically we see like, when we're looking at our credit trends, we very often look at 30, 60, 90 days, but
Yeah.
that's quite different, isn't it, for the food
Well,
industry?
this is something that we're bringing. We're bringing something new to Equifax. We have like the terms are 7, 14, and 21 days in
Yeah.
most of the time. And actually, the food service suppliers, the one that are selling to the restaurants, are bringing back the terms. There were lots of competition in the last years, giving like 30 days terms, 45 days. Now they're going back to the 7, 14 days terms, actually pre-authorized debit, pre-authorized payments. So this is something new that we're seeing with the COVID. Actually, they had the opportunity to bring back the terms to the shorter terms. And this is something that we're seeing a lot in the industry. I think that will be a trend. We're seeing that from the big suppliers, the big food service suppliers right now. So shorter term will be something that we're going to see more in the future. Companies won't sell terms as they were doing in the past.
Interesting. And then maybe this one's for Josh, perhaps. Any insights on how financial institutions will approach mortgage and real estate in the near future?
That's a great question. Probably cautiously, but at the same time, with the current situation of supply being incredibly low, in Canada, we need more houses. We need more commercial space, certainly more manufacturing space. I don't see any significant decrease, but I definitely think there's going to be a lot more caution and a lot more due diligence in terms of underwriting mortgages for sure.
Yeah. That's it. Okay. Well, maybe we will end there because we are getting very close to time. So I want to thank both of you gentlemen today for joining me. Fantastic discussion. It was very insightful, definitely from my perspective. So really appreciate your time. And as always, thank you to everybody who joined us today and took time out of your busy schedules. I hope you also found the discussions insightful and learned something new that you can leave here with today as you grow your own business in 2023. Before you log out, if you could take a moment to fill out the survey and feel free to share any thoughts about today's webinar, as well as any recommendations for future events that you'd be interested in having us cover. We'd love to hear from you. So if you'd like to share this session with a friend or a colleague, a link to the recording will be sent out in the next 24 hours. You can watch your inboxes for that. And as always, a very special thank you to the behind the scenes production team, Stephen, Sandra, Jordan, Robin, Bala, and Swarnima. Robert as well and his entire team for helping pull this all together. It takes a village. So have a wonderful rest of your day and we will see you again next time.